All right, we are now back to begin our last chapter this evening. I got out and got back in to make sure that we're on track here to discuss and we don't get cut off like we have in the past. So we are into, oh boy. I'm sorry I cut myself out, and now we're back. So, learning goals for financial management. We explain the roles and responsibilities of financial managers, uh, outline the financial planning process, uh, and explain three key budgets in the financial plan. Explain why firms need operating funds. It should be self-explanatory, but we're going to go through that. Identify and describe different sources of short-term funding, short-term financing, and then identify and describe different sources of long-term financing. All right, so here we are. We ask a question, what's finance? We kind of alluded to that in the last chapter, but we'll talk about it a little bit more here. The function in a business that acquires firms for the fund and then manages them within the firm. So we normally, big firms have a financial manager. Large firms usually call the person a chief financial officer, CFO. And then what do these people do? Well, they help prepare the budget. And I say help prepare the budget. The reason I say help prepare the budget is they usually get guidance from the senior executives, the CEO, sometimes from the board of directors. And I'm talking here about large firms. So then based upon that, they'll prepare the budget from the guidance that they were given, create cash flow analyses, and then plan for expenditures. Financial management. Pretty good little thing here showing us with the piggy bank. Good analogy. We're just going to this person or persons, but usually the person in charge manages the firm's resources to meet its goals and objectives. Financial managers. What do they do? Well, they examine the financial data that they have on hand. They probably will send a report summarizing that financial data to the other executives within the company. And then they're going to recommend strategies for improving financial performance or keeping financial performance going the way it's been going. In other words, marching in the same direction if it's doing well, and if it's not doing well, then make these strategies. They're also responsible for ensuring that, and I'm doing this from the standpoint of large companies and small companies, that's 500 or less employees. They may or may not have a financial manager, so somebody is going to be responsible, but designated to pay the company's bills, also to collect what's due to the company, making sure they're staying up with the markets, financial markets, investment markets, etc., and ensuring that the accounting for the firm is accurate. And this just gives you some idea of what we call these people: CFO, Chief Financial Officer. A CFP is a Certified Financial Planner, and I'm not certain that all companies are going to have this kind of person. We normally think of certified financial planners as being someone that helps an individual manage his or her finances, although firms will have this. But normally that person is going to be rolled into, at least in my term, my feeling, the CFO. A CFA is a Chartered Financial Analyst, and then the comptroller is the Chief Accounting Officer. Now, the people who are certified or chartered, as we talked about here, they've been through some education process, some school process, some continuing education to achieve that certification or charter designation, and then they are required by their by their associations to continue education to stay current within their fields. And this just gives us a graphic description of what the financial managers do, or that they oversee being done: auditing, managing taxes, advising on financial matters, collecting the funds. We've talked about that, controlling them, obtaining funds if we're talking about needing investment, etc., budgeting, planning, and so forth. Now, this particular slide says to us what worries the financial managers. And obviously, the first thing that comes to mind is that we're not going to sell enough product, that the credit markets may start rising. Now, right now, our interest rates to borrow money are at historic lows. What happens when that starts creeping up? Any regulations that are promulgated by various and sundry governments? How well the dollar is doing. Right now, we have a very strong dollar. And that means that, for the most part, goods and services that are imported into this country are less expensive. By extension, goods that we sell outside this country are more expensive. Although the dollar is trading fairly favorably against the euro. It takes about $1.37 to buy a euro. So that means that our goods are less expensive overseas. Of course, Europe is not our major trading partner. They are our large trading partner, but so we have to be concerned about other ones like the Chinese yuan, etc. This particular slide talks about the other concerns for CFOs on the micro side. That's in the firm itself, ability to maintain margins, and obviously a positive margin, forecasting ability, how things are going to go, maintaining morale and productivity. Now, that doesn't necessarily fall to them, but that's something they're concerned about. If you don't have good morale with employees, it's going to affect productivity. Affordable health care. I don't think most of us know what the impact of the Affordable Care Act is going to have on companies. Probably not going to have a whole lot of effect, but it may have some. That's still to be played out. And then working capital management. Financial planning is another avenue that we have to be concerned about, and the financial managers are going to be concerned with both short-term and long-term money flows, and achieving or getting money on a short-term or a long-term basis. That would be, I said achieving, I shouldn't have used that word, getting that money that they may need for various and sundry things. So there are three key steps that in financial planning, we sort of alluded to them before. That's that forecast of money that the company is going to need short-term or long-term. What's it going to need it for? how long does it need it? How well is it able to turn that money over, to pay that money back plus interest, etc. Obviously, there has to be a budget developed, and then there have to be financial controls. And not only do there have to be financial controls, but there has to be a check and balance there. One of the things that got into a problem with a city that's close here to Cincinnati, not the size of Cincinnati, but it's very close, is that they had a large amount of money embezzled from the city. And part of the problem was that the person who was in charge of the finances, financial director or whatever his and it wasn't him, whatever his title was, it was, he also oversaw the information management. So he could move things around, and there was nobody there to watch over what he was doing. So that's an important issue for other people to pay attention to. And this is just talks here about what we've mentioned: short-term forecasts, long-term forecasts. Notice that a short-term forecast is a 12-month period or less. And then cash flow usually tends to be a much shorter period of time, normally is in months or quarters. And it talks about inflow and outflow. What's our projected inflow? What's our projected outflow? Should have a pretty good idea on projected outflow, unless there's been some need to buy additional raw material or something of that nature. And then finally, the long-term forecast, which is more than 12 months, usually is capped out at 5 years, but sometimes you'll see it go as far as 10 years. And budgeting. Now, we've alluded to these budgets, talked about long-term budgets and short-term budgets. So this is just giving us an idea. It's kind of like, look at this like your checkbook. What's coming in, what's going out. Coming in would be any pay that you have coming to you, or money you are accruing from investments that you're getting, some kind of money paid to you because of your investments, or from, that could be interest on money you have in the bank, or savings and loan, or credit union, or something of that nature. Budgets, notice here, depend heavily on the balance sheet. Now, they don't depend on the balance sheet, but they depend upon what the balance sheet is talking about. Income statement, statement of cash flows, etc. So they don't depend on that because things don't depend on other things. But a budget is produced based upon the information contained in these documents. And the budget, remember, the thing about a budget is it's a guide. It tells us what we should do given these certain parameters. It doesn't mean the budget cannot be changed. It doesn't mean that the budget can't be revised. It doesn't mean that the budget can't be in some way massaged. Now, when I say massage, don't take that as a term I'm gonna fool with the books. That's not meant to say that. What it says is that there should be an overarching budget. Everything fits into that. And as that overarching budget changes, things within it might change, or things within the overarching budget may change based upon what's going into it. These things here are the statement, income statement, statement of cash flow, etc. Several different types of, of budgets that organizations are concerned with. A capital budget is, like I like to say, is the big ticket items, major purchases that require a lot of money. The cash budget, again, here we're talking about cash coming in, cash going out, during a particular period of time, usually a month or a quarter. And then the operating budget, which I just alluded to, excuse me just a second, please. A operating or master budget, which I alluded to, I called it an overarching budget because it ties everything together. So it's, everything feeds into that budget, and it gives a summary of what we're going to do. Now here are the tentacles, if you will, of financial planning. So we have financial planning at the top here, and we see that we have the operating budget in the center, or the master budget. And from that, we have the capital budget, cash budget, and then financial controls. And then, of course, the financial plan that we've talked about. We're going to have the short-term and the long-term forecast. So this just gives us a graphic display of what we've talked about in the past year. This is an important thing for every company. It is probably more important for small companies than it is for large companies. That might sound a little pretentious in a way, but one of the things that normally happens to small companies that causes them pain is that they're not able to control their finances well. They don't have a good handle on their finances. So financial control is really important for every company, but probably doubly important for a small company because it does not have the ways in which it can move money around, doesn't have the ability to borrow money as easily as a larger company does. So financial controls are really very important. And this is, as the slide says, it's a periodic review of what's coming in, revenue, and what's going out. So it compares actual revenue, what we actually brought in, with our costs and expenses, cost buying raw material, and then expenses being, pardon me, expenses being salaries and utilities and rent and things of that nature, and with the budget. So it's kind of a check and balance here, if you prefer. So these are the factors that go into assessing financial control. Are we meeting our short-term commitments, financial commitments? Are we making enough money on our assets? So in other words, what that means is, are we selling our goods and services at a rate sufficient enough to generate profit? How are we financing our assets? How is the firm financing its assets? Are we borrowing money? Are we selling stock? Buying bonds? How are we doing that? And then, are the owners, large company, that would be stockholder if it's a publicly traded company. Not a publicly traded company, are the owners receiving an acceptable return? So whoever we're going to call the owners, are they receiving an acceptable return? I'm going to pass the progress assessment and move to, these are the key needs of operational funds on any firm. Day-to-day business needs, we have to manage these. Controlling credit operations, and don't necessarily think just of credit cards. Getting the needed inventory that we have to have, either for raw materials to produce something or something of that nature, and then making the capital expenditures we need to keep the business moving in the direction in which we want it to move. This is a legal briefcase scenario that I'm not going to talk a great deal about, but I do always suggest that you look at these things because it gives you greater insight into things that are going on. Now, how does a small business improve its cash flow? Well, I think the first and foremost thing is that, as the slide says, and I subscribe to this not because the slide says so, but I think this thing is to be as aggressive as possible without being overbearing to get the accounts receivable in on time. And one of the ways you can do that is to offer a discount. So if it's important for you to get money into the company, I'm not suggesting it never isn't, but if it's important for you to get money into the company and keep it generating, you may want to say, okay, I'll offer you a discount, let's say 1% off your invoice if it's paid in cash within X number of days. Used to be, we'd see years ago, 1% in 10 days. That means you take 1% off in 10 days if you paid the bill within 10 days. It may be extended now. You may want to do something different, but that's a way to get the money back. Now, of course, you have to, I'd say get the money back. Get the money back, and so you can do other things with that money, buy more material, and do whatever else that you need to do with the company. Of course, you have to make sure that you can do that. Does your budget allow you to offer that 1% in 10 days or 1% in 30 days, whatever it happens to be? So you need to look at that, make sure you can do that. So what you're doing here is you're telling the customer, hey, I like your business, I want to keep your business, I'm going to offer you a special deal. If you pay me within X number of days, I'll take something off your invoice. You may have special ways of paying your vendors, and they may extend the same thing to you, a discount if you pay early, or you may be able to work out the different arrangements with them. I always worry about raising prices because that's not always palatable to your customers. You may be forced into it because cost of raw material went up. Other overhead went up, and so you have that money has to come back some way. I always think that should be one of the last things a small company ought to do. Yeah, sometimes it's necessary and sometimes it's painful, but I think you ought to try every other avenue before you get there. And of course, use credit cards wisely. We can't talk about that often enough. Good finance or bad medicine. This is, again, an ethical decision-making scenario that you find in your text. I recommend these to you. It's not something that you have to do, but the scenarios are good. And so look at those and see if anything there's applicable. You can learn something from that, reading those scenarios. Now, there's alternative use of funds that you can do. You can do debt financing. Debt financing is borrowing. We can't clean that up any. And you have to understand, if you borrow money, you're going to have to pay it back. There's always interest rate that's on that. And so you have to figure out what the best avenue for you to do. Equity financing is different because that's borrowed from within the firm. It can be borrowed from operations. It can be borrowed from the sale of ownership through stocks, etc. So you get extra money coming into the company. It's not costing you for that money. In other words, you're not going to have to pay interest on that money, but you're giving something up. So anytime you're going out and getting alternative sources of funds, you have to realize that that is going to cost you something. And you have to determine what that something is and what's palatable for you to do, and what's the least costly and is going to give you the best benefit and greatest return for your buck. Obviously, there are short-term and long-term financing strategies, and you have to decide which is best for you. Short-term is something that's going to be paid less than a year. Long-term, something longer than a year. How long do I need the funds? What's it going to cost me? Sometimes short-term financing is more expensive than long-term financing. So you need to look at what the interest rate is, what it's going to cost you, etc., to make a decision of short-term or long-term financing. Now, this gives you a graphic picture of different types of funds. Short-term, maybe to meet monthly expenses, unanticipated emergencies, having cash flow problems. That happens frequently. Maybe you're going to have a promotional program and you need the money to push that out. Long-term, new product development, expansion in new markets, new facilities, etc. Replacement of capital equipment, which is very important. Now, these are the types of short-term financing that are available. Trade credit, buying now and paying later. Sometimes you get this, what notes here, 210 net 30 days receiving trade credit. And of course, there's always a promissory note, which says, I'll pay you a specific sum of money at a definite time. Remember that if you do this, that's a contract. And it has force of law. So whether you go and you have a lawyer draw this up or somebody else draw it up, doesn't make any difference. It has force of law, and we have to recognize that. Short-term financing can come from friends and family. That's always difficult. There's nothing that will separate friends and family from each other more quickly than borrowing money. You have to be very careful about that. If you do that, it should be done by contract. I mean written contract. If you even enter into, would you loan me money, that's a contract, but it's better if it's in writing because everybody knows what was said and what was agreed to, and nobody has memory lapse. Agree to specific loans, put it in writing. I already said that, and then arrange for prepayment, just like you would with the bank. If you're borrowing from friends and family, and you have the ability to pay that money back ahead of time, I'm pretty sure they're gonna want it ahead of time. Really, it's been even though we have historic low interest rates today, it's been very difficult for small businesses to borrow money, especially for startups. The banks just do not want to lend to anybody that they're concerned about. And they've kind of gotten away from some of that traditional thing. So it's best for small businesses and looking for this short-term financing to try to turn to angel investors. I always shy away from recommending venture capitalists because that's not always the best thing that you want to do. Very, very difficult to get money today. This is a slide that I'm not going to spend a lot of time on. Just talks about how small businesses can get financing, peer-to-peer lending, this thing called Lending Club, and this organization called Lendio. Notice the term here, though, this used, claims to have developed a technology that matches business owners with the right type of business loan and lender. If you get into this stuff, make sure you know what you're doing. Read all the terms and contracts, and make sure that the people that you're doing business with have some standing in the community and people know about that. Different types of loans: secured loan, unsecured loan. Secured loan is backed by property. Unsecured loan is not. So the lender, is not asking for you to put up collateral. Line of credit is extended by a bank, and the bank will normally extend this line of credit so long as those type funds are available. And in revolving credit agreement, line of credit that is guaranteed, but it comes with a fee. Factoring is something that's a little bit different. A lot of times a small business will sell its accounts receivable for cash. Usually this only happens when they're having a cash flow problem and they need to have this money. Obviously, they're not going to get everything that the accounts receivable are worth. I do not know what the factoring people will charge, but it's not insignificant. They will, and notice it says they charge more than banks. Now, this is also getting loans from these folks as well. So you're not going to go to the factoring people and get the same rates you're going to get from a bank. Commercial paper. Notice it's an unsecured promissory note for $100,000. It is due in 270 days or less. That means it has to be repaid with any interest in 270 days. Normally, notice here that only financially stable organizations use commercial paper. Credit cards. I'm not going to go through this whole thing about credit cards. I'm just going to tell you, if you start a small business and you're going to use your credit card, be very, very careful. Understand that those interest rates are very high. You need to also know that once you use a credit card, you're actually borrowing money. The credit card company has lent you money to pay that debt. So if you go to a restaurant for dinner and your bill comes to $100, you pay $100, that is a loan the credit card company has given you, and they expect you to pay that in full within a certain number of days. And by the way, the number of days has been shortening and shortening, so you don't have what you used to have. I don't remember what it's down to today, but it's a very short window. So just be careful. I will give you an example. I remember this from some years ago, and it probably changed today, that if you had $1,000 on your credit card and you only paid the minimum amount due, whatever that happens to be, it will take you 10 years to pay that $1,000 off if you only pay the minimum due every month. So think about that. Be careful when you use your credit card. Understand that it is a debt. Here are ways to raise startup capital. You can seek out a micro loan. Those things are available, and there are places that you can find out about them. You go to maybe the local Chamber of Commerce or the Small Business Administration. They'll do that. Turn to the web, seek out peer-to-peer lending. look at your local banks. There may be some that you do that. Some vendors will loan you money. Make sure that you set both long and short-term financial objectives, and they have to go in concert with the organization's overall long-term and short-term goals and objectives. Five C's of credit is probably something we all can take away. We have to look at the character of the borrower, his or her capacity to repay the loan, the capital being invested in the business by the borrower, conditions of the economy, and finally the collateral the borrower can put up to secure the loan. Long-term debt financing usually comes due within 3 to 7 years, but it could extend much longer than that, 15 to 20 years. You continually hear of large companies refinancing their debt. That's when they're past that 3 to 7 years. Term loan agreement, we know what that is. Tells when we're going to repay the loan and whatever interest rate is also due. A major advantage of debt financing, which are bonds, is that the interest paid is tax deductible. This is debt incurred by bonds, indentured terms, that's the terms of the agreement. Secured bond, we know what that secure is. We're putting up some type of collateral, usually it's real estate. Unsecured, we know what that is. Only issued by the reputation of the, backed by the bond that's backed by the reputation of the issuing company. Well, we have to sometimes, in some cases, secure equity financing. We can sell shares in the company if those are available. Remember, once we do that, we're losing some control of the company. Taking profits and the retained earnings and reinvesting those in the company, and then attracting venture capital. As I've talked about that before, you have to be careful with venture capitalists. It does not mean to say that they're bad people, but they want their money. They've invested in this company, and they, when times due, they want their money. So you have to pay attention to that. There's ways to attract venture capitalists. They're going to look and see if the company is going to make a profit and will grow. They want to know if they're going to get their money back, and they want to know if it's going to be worth investing. Here's the difference between debt and equity financing. Debt, there's no management influence unless for some reason there is. If you do equity, which would be stock, then the common stock owners have a vote. Repayment, the debt has to be repaid if it's a bond on its maturity date. That's usually debt's talking about bonds. Stock, no maturity date. Debt, again, bond, there is interest that has to be paid. Equity, the firm is not required ever to pay dividends on stock. Interest on debt, usually bond, is tax deductible. Dividends are not tax deductible. Another thing you have to be concerned about is leveraging. raising funds through borrowing to increase the firm's rate of return. Be careful about that. The cost of capital rate of return a company must earn in order to meet demands of its lenders for expenditures for equity stockholders. Equity holders, usually stocks. We have to pay attention to crises. We have to understand that they do recur at inopportune times. We've had, I think, 9 or 10 recessions since the end of World War II. And so we have to pay attention to that. We know that the government is increasing involvement in intervention. That is not necessarily a bad thing. Government does this to protect investors, to protect borrowers, and so we have to pay attention to that. And at 7:03, that brings us to the end of chapter 18. We spent the last 40 plus minutes talking about financial management. And so I look forward to meeting with you again next week to talk about managing financial resources, which is chapter 19. And then also talking about, excuse me, that's not chapter 19. Federal Reserve, money in the Federal Reserve is chapter 20, and chapter 19 is managing financial resources. Get that right. So thank you. I'll try to get these loaded into the with the lecture notes as soon as possible. And I appreciate your attendance this evening, and I look forward to speaking with you next week. Thank you and good night.